Reddit says this strategy is free money. Today, I'm putting the ORB strategy, also known as the opening range breakout strategy, to the test. So I found dozens of posts, both online and on Reddit, claiming high win rates, clean setups, and consistent profits. This video has one goal, and to test whether all these claims on the high success rates of ORB strategy is true. So firstly, what is the ORB? So in order to trade the ORB strategy, first when market opens, you want to wait for 15 minutes, 30 minutes, or an hour. So this is called the waiting period. And after you have waited for this, let's say 15 minutes, this waiting period, you take the high and the low, and that's your range. So within that 15 minutes, the high and the low, that's your opening range. So once after the 15 minutes, when price breaks above your range that you have set, you buy. If the price breaks below your range, you sell. Simple, sounds simple, but the details actually really matter. So the time frame, like I mentioned earlier, really matters. Whether you choose 15 minutes, 30 minutes, or 60 minutes, really matter. What stop loss you put and what take profit you put also really matters for the ORB strategy, and that is what we're going to test for the rest of this video. So how did I test? So what I did was that I did a full systematic backtest on the ORB strategy. I used 100 plus stocks over 2 years of data. So stocks including Google, Amazon, United Health, so a range of stocks across all sectors, all industries. So the first thing that I want to test is time frames, because like I mentioned earlier, online people use so many different time frames, 15 minutes, 30 minutes, 60 minutes. Which of these performs the best? So based on this chart, the 15-minute one performed the best. 30 minutes and 15 minutes are roughly equal, but there's one, the 60-minute one performs significantly worse than the other two time frames. The reason being, at 60 minutes, it's probably too slow. The momentum has already dried out and the ORB strategy just doesn't work anymore. So time frame, moving forward, I'll be using the 15 minutes time frame only based on what I've tested in the data. Next up, I'm also looking at entries and exits. So what take profits or stop loss that I'll be using. So online cited multiple different take profits and stop loss, also known as risk to reward, that one could use. The most common one is 1-to-1 risk to reward ratio. So it means that, let's say you are risking $5. So for example, if your stock price dropped $5, that's your stop loss. And if the stock price rises $5, that's your take profit. So you're risking 5 to gain 5, 1-to-1 risk to reward. So that's the first one. There's also people that use the 1-to-2 risk to reward. That means you're risking 5 to get 10. So you see, it's you're risking a smaller amount to get a bigger amount. And lastly, some people also use the 1-to-0.5 risk to reward. So that means, again, the same example, my stop loss is 5 units and my take profit is 2.5 units. So the reasoning behind that is I just want to increase my win rates. So from this chart, I backtested all a combination of these stop loss and take profits. And one thing is clear: taking profit too early underperforms. So that's the two lines at the bottom. The two lines at the top of the chart is the 1-to-1 and the 1-to-2 risk to reward ratio. You can see both of them are roughly equal. The 1-to-1 performs slightly better. However, generally I prefer a 1-to-2 risk to reward, because that would mean even though my win rate is slightly below 50%, I would still be earning money. Again, nothing wrong with choosing the 1-to-1, but based on data, both of them are roughly equal. And moving forward in this video, I'll be using the 1-to-2 risk to reward ratio. After testing it with a 15-minute time frame and a 1-to-2 risk reward, the end result is that I got a profit factor of 1.04. So a profit factor of 1.04 basically means I'm risking $1 to get $1.04. And that's horrible. So I analyzed the data and I found a few things. First thing, time. So from this chart here, you can see that early morning performed a lot better. The reasoning behind this is that early morning, the stock has a lot more momentum, and ORB strategy is after all a momentum strategy. So you need enough momentum to make the stock achieve to hit its take profit. And so from this analysis, I'm going to ignore any trades after 11:30. So that's a filter that I'll do. The second thing that I realize is risk to reward. You can see from this chart again that below 1.25 risk to reward, my profitability decreases. You might question, I thought we already set a 1 to 2 risk to reward. Why do we see a range here? The reason being, we only enter our trade upon candle closure. So for example, if the candle closes past the entry line, far above entry line, our risk to reward decreases. So again, from this second analysis, I won't enter trades below a 1.2 risk to reward. I only enter trades which have a R to R above 1.2. So that's the second thing that I analyze. The third thing that I found has to do with ATR volatility. So there is some sort of pattern among the bad trades that I looked at. So trades that always hit the stop loss, or trades that doesn't hit a take profit. What I notice is a pattern. And this pattern is that during these down days, these bad days, my ORB range is unusually large. So when the range is large, that means I have a higher, I need to travel, right? Stock price need to travel further in order to hit its take profit. So it needs to move more in a direction. So when the range is large, it means a lot of momentum has already happened within the range, and there's no more fuel to carry it forward to hit its take profit. So the idea here to fix this is that I want to use some kind of cap that says, oh, if this stock has already traveled too much within the ORB range, don't trade it. Instead of a hard cap, I use ATR filter instead, average true range filter, instead of a fixed cap. The reasoning behind this is that different stocks have different volatility levels. So for example, it's normal for Tesla to move a few percent a day, whereas it's not normal for Johnson & Johnson to move a few percent a day. So a cap based on ATR volatility is what I used. So those are the 3 filters that I did to improve the results of my ORB based on data. So the results after refinement, the profit factor increased to 1.1. So here we can see I got a win rate of 41%, a profit factor of 1.1, and only 2 out of 9 losing quarters. But this is not good enough, a profit factor of 1.1. Why? Remember, when we are trading, there are hidden charges. There are commission charges when you place a trade. There are slippage as well. The buy and sell of the stock isn't exactly perfect. So you got to account for all these slippage and commission charges when trading. So what I'm truly looking for is a profit factor of above 1 point, closer to 1.4, above 1.4, 1.5 to be truly profitable. So not good enough currently. And I dive deeper into the data, and then I realized there's 2 things that all those people online, all those posts on Reddit doesn't tell you when you are trading the ORB strategy. So these 2 things, the first thing is that what stock you are trading on actually matters. So the ORB strategy doesn't work on all stocks. If you think about it, ORB, it's a momentum strategy. To have true momentum, you need large volume. And large volume only comes from institutions like hedge funds, algo trading bots. You need these institution participation to get a clean ORB break. So the first thing then I look for is stocks with large institution participation. These could be ETFs. This could be the mega cap stocks. So I sort of break it down into 4 categories. First, the ETF category, because I know these guaranteed have large institutional participation. I then have a tier 1 category. This tier 1, I sort of classify it as the, for example, Amazon, Google, Meta. These are the top 10 of the S&P 500, which I know institutions are in it. And then I have tier 2 stocks, which I'm less sure that institutions are interested in. So this could be like CrowdStrike, Palantir. There are still hot stocks that institutions are interested in, but just not as strong as Google, Meta. And tier 3 are even lower institutional interested stocks. And from this chart, we could see that tier 1 performed the best, and profit factor, most importantly, profit factor has significantly improved. So that's the first finding. Only high institutional participation stocks works. The second thing that I found is that trend alignment matters. So what I mean by that is that if you're going long on an ORB, you want other trends, for example, the daily, weekly time frame, to also shows bullishness to support your long trend. So I included an extra 5 momentum filters. The first one is daily. So if the daily is bullish, that's a good confluence. If the weekly is bullish, that's again a good confluence. Pre-market, so I want to make sure the pre-market is the same direction as well. So that's the third one. The fourth one is gap. So let's say yesterday closed at this price, and if today's opening price or the ORB break price is opening price is here, there is some sort of gap between yesterday's close and today's open. So that again is a bullish confluence for me. And the last one is if my ORB breaks above the previous day high, that is a strong bullish confluence for me as well. So 5 momentum filters I use. And when I did analysis on these momentum filters, I realized if I satisfy 3 of them, so an extra 3 confluence on these momentum filters, I get a profit factor between 1.16 and 1.71. So you can see again, my profit factor is increased from a baseline of 1.1 to now between 1.16 and 1.71. If I use 4 filters, my profit factor has a range of 1.5 to 1.94. And if I use 5 filters, so all 5 momentum filters confluence, I have a win rate of 51.8%. You might think this is not high, 51.8%, but remember, our risk to reward that we are using is 1 to 2. So all 5 confluence gives me a 51.8% win rate with a 2.19x profit factor. And what we notice is that now with a 2.19x profit factor, our results have significantly improved. To conclude, is this strategy viable? So our numbers are looking like a real age now, like a profit factor above 2 is something worth considering. But what I know is that the ORB strategy that Reddit mentioned, the simple basic ORB strategy, doesn't work. What you need to include is definitely stock selection and confluence with other momentum filters that truly brings up your age. So the next few months, I'll be testing this on live data, not historical data, using real fields, real slippage, real commissions. And if you want to follow my journey, subscribe. If you enjoy my video, do give a like. And if you have any comments, put it in the video and I'll try to answer it as best as I can.